Today, crunch, forget that new mortgage. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Today we look at the fixed rate mortgage crunch and a substantial drop in mortgage borrowing power, which will dent the property market and put households under even more financial pressure. The rubber is now hitting the road with regard to higher mortgage rates as the banks continue to announce more higher fixed rate loans. During the week, both ANZ and Westpac increased the fixed rates, ANZ by 0.9 percentage points and Westpac by 0.5 percentage points. CBA and NAB both lifted fixed rate home loans earlier this month. So now we've got fixed rates for owner-occupiers starting with a 5 and in some cases a 6. Fixed rate mortgage lending boomed over the pandemic, lifting its share of new mortgages to a record high of 45% late last year, according to APRA data. And CBA head of Australian economics Gareth Aird says around $500 billion worth of fixed rate mortgages are due to be refinanced by the end of 2023. And under the Economist's median interest rate forecast, the average discount variable mortgage rate will rise to around 6% by mid-next year, whereas the futures market is tipping mortgage rates around 7%. Now, the ABC recently did a story about Australians that took out fixed-rate mortgages over the pandemic and are now fearful that their repayments will balloon once their loan terms expire. And Sibarim and her partner took on a home loan of more than $1.5 million in Sydney with a deposit of 10%. They are among almost 40% of Australians with mortgages who have locked in ultra-low fixed rates and will roll them off as soon as next year and potentially face a world of financial pain. We fix the majority of our mortgage for 2 years and we assume that in the next few years they wouldn't really go up much, Ms. Umbrum told ABC News. It took us years of going to auctions, it took us years of going to inspections and years of savings and a lot of bulk shopping and buying second-hand clothes and not buying certain things. Sacrifices were made, she said. And she said she relied on repeated statements from the Reserve Bank that interest rates would not go up until 2024. For Ms. Ibrahim and her family, that means a rise of almost $20,000 a year on their mortgage repayments. That has been really anxiety-inducing to think that interest rates will go up by that much and that we would have to try to weather such a large increase at a time when there are obviously other upward pressures in relation to the cost of living, she said. It's been really stressful thinking about that and thinking about how we're going to manage such a loan. Financial Counselling Australia Chief Executive Fiona Guthrie said a lot of people have borrowed to the hilt, and she's shocked banks have been letting people borrow 6 or more times their incomes with very low deposits. Ms. Guthrie said that they are already seeing signs of people in financial stress and that it's set to worsen under higher interest rates. We've also got the costs of petrol going up, the cost of food going up, the cost of electricity rising, and all of those factors are playing into what could become quite serious financial problems for a group of people in our community, she said. And the AFR reported that lenders are cracking down on property buyers and renovators by tightening borrowing conditions amid growing concerns about increased risks because of rising mortgage and building costs. Residential property buyers are having to provide lenders much more detail about spending and income as living expenses soar, experts say, squeezing their capacity to meet rising mortgage costs, particularly in high-cost Melbourne and Sydney. Renovation and construction borrowers also having to provide bigger deposits as labour and material bills blow out, doubling construction costs and forcing many to renew their loans or postpone the development. Borrowers and lenders are growing nervous as cheap loans come to an end and the regulators turn up the heat, said buyer's agent Phoebe Blamey, a director of Clover Financial Solutions. The Australian Prudential Regulatory Authority, APRA, recently wrote to lenders warning them of the need to tighten scrutiny of higher-risk residential borrowers, such as loans at a high debt-to-income multiple or a high loan-to-value ratio. Belatedly, in fact, the prudential regulator has put banks on notice that they must be ready to rein in risky home loans made to highly indebted customers after new data showed that the number of mortgages to borrowers with high debt-to-income ratios eased back slightly from record levels following its targeted action last month. In the letter to banks, the Australian Prudential Regulatory Authority outlined new requirements saying lenders would need to have systems in place to limit the growth in higher risk residential mortgage lending, such as loans at high debt-to-income multiples or high loan-to-valuation ratios. The warning came after APRA's latest data for the March quarter showed that 23.1% of new mortgages had a debt-to-income ratio of 6 times or more, the level considered risky by the prudential regulator. That is $32.7 billion worth, with a debt-to-income ratio of 6 times or more in dollar terms, and that was down from a record high of 24.3% or $40.6 billion in the previous quarter, but it's still almost triple the rate from March 2019 when it was just $11.4 billion. And in terms of new home loans written, in March 2022, about $10.5 billion worth had loan-to-value ratios of 90% or above, meaning a deposit of 10% or less. That was slightly down from $13.3 billion in December 2021. The March quarter was the first full period during which the impact of APRA's move to increase the serviceability buffer from 2.5% to 3% was in place, hinting that the stricter rules to limit lending are starting to work. And it should be noted that the number of loans being approved outside normal serviceability criteria, though, is rising, and that's not a good sign during this part of the cycle. At the Australian Financial Review Banking Summit at the end of May, APRA Chairman Wayne Byers said that historically, housing loan portfolios have been low risk and acted as ballast for the industry through turbulent periods. And he said housing loans have been, as they say, as safe as houses. However, he went on to say that may not be the pattern in the future. We are now entering a very different environment than has existed for much of the past decade. The faster-than-expected emergence of higher inflation and interest rates will have a significant impact on many mortgage borrowers, with pockets of stress likely, particularly if interest rates rise quickly and, as expected, housing prices fall. At most risk will be residential mortgage borrowers who took advantage of very low fixed rates over the past couple of years. These households face a sizable repayment shock when they refinance in the next year or two, possibly compounded by having loans that are larger than the diminished value of their property. Interestingly, this lending growth has not been an industry-wide development, but rather has been concentrated in just a few banks, he said, suggesting it won't be just households under the regulator's microscopes. ANZ and National Australia Bank last month revised down their maximum debt-to-income ratios from 9 times to 7.5 times and 8 times respectively. APRA's focus on housing risk on a bank-by-bank basis contrasts with its blanket approach in 2015 and 2017, when macro-prudential policies to reinforce sound residential mortgage lending practices came during an upswing in the financial cycle as housing prices were rising, and that, of course, was a focus on the investment sector. This time, interest rates are being lifted off record lows, and house prices are expected to fall over the coming year. This should see the level of high debt-to-income borrowing begin to moderate. Well, perhaps. Nevertheless, APRA asked all banks to be ready to respond to the new rules if they are needed. In the current environment with high household indebtedness and rising interest rates, it's essential for banks to prudently and proactively manage risks in residential mortgage lending, Byers said. APRA expects lenders to closely monitor housing lending risks to ensure that aggregate portfolio risks remain within their risk appetite and that standards for new lending remains prudent. And while analysts have stressed that their mortgage portfolio losses are historically low, with losses well provisioned for during the pandemic, thanks to the extraordinary provisions APRA made to allow mortgage repayment holidays not to count towards bad debts, that's all gone now, and the falling volume of new loans as stricter lending criteria takes effect has prompted concerns about the bank's growth being able to catch up to their expensive valuations. Now, the latest policy changes by lenders to tighten terms and conditions for mortgage borrowers include increasing deposits and reducing the amount lenders can borrow, tightening evidence of income, particularly for contract and casual workers. For example, many lenders have scrapped the use of overtime worked or any bonuses as evidence of capacity to pay, replacing the ATO notice of assessment, which reflects taxable income after deductions, with the more up-to-date income statement that shows year-to-date salary and wages plus any withheld tax. Updating verification of all loan commitments from latest statement to latest statement dated within 30 days from the application date. And others are reviewing up to 2 years' history of borrowers' repayments for all loans, including personal loans and credit cards. Providing evidence of deposits for any other loans, regardless of the loan-to-value ratio, and adding the location of the property to the living expenses section in the loan application used to review an applicant's housing expenditure measure, the HEM, which is used to determine available income for repaying a loan. Major cities such as Melbourne and Sydney have much higher living costs. And also adding in payments on both HECS and buy now, pay later in assessments. So household budgets will continue to be squeezed as rising energy costs and continued inflationary pressures are expected to push inflation to about 7% later this year, according to the RBA, and it may be higher, of course. Many think inflation will go a lot higher. Rate City, which monitors lending rates, says the maximum borrowing capacity of individuals and families will shrink by up to around 18% as rates continue to rise. It shows that a family with an annual pre-tax income of $150,000 with no additional debts and minimal expenses will have its borrowing capacity reduced by more than $163,000, or around 17%. And the analysis is based on April's average variable rate of 2.41% and the 4.66% estimate rate by next April. It assumes a family of 4 seeking a 30-year principal and interest loan. For the same family with a pre-tax income of $400,000, the reduction raises to more than $515,000, or about 18%. And for a single person earning a pre-tax income of $100,000 with no additional debts and minimal expenses, the reduction in borrowing capacity is around $129,000, a decrease of around 17%, rising to about $314,000 for a similar person earning $250,000. Other analysts, such as Carlos Cacho, chief economist at investment bank Jarden Australia, believes rising rates and pressure on discretionary spending will result in a 25% fall in borrowing capacity. Cacho expects property prices will fall by around 20% nationally, with even bigger falls in Melbourne and Sydney, which would be the biggest drop since 1980, when Malcolm Fraser was Prime Minister and the average house price was $76,500. And in addition, a record boom in home renovations and unprecedented demand for timber and other building materials is increasing costs by up to 80%, with many renovators and those building their own homes facing even larger increases. Renovations and construction loan lenders are increasing deposits by more than 10% and have recently increased loan rates broadly in line with recent moves in the cash rate, said CanStar, which monitors interest rates. Some renovators are in shock because rising costs of materials and labour are causing originally quoted prices to double, said Jelena Savesa, an architect at Urban Den Architects in Sydney. She said demand was booming for new kitchens, bathrooms and home offices, which include additional room for an assistant and audiovisual equipment for video conference. It's really tough for renovators, she says. Some are postponing any construction for a couple of years until the market calms, and they are claiming it is not worth it in the current market conditions. Disputes can arise because renovators do not have a clear idea of what they want or how much they want to spend, which may mean changes midway through a project, said Phil Dyer, a builder and national president of the Builders Collective of Australia. Dyer recommends checking the builder is a registered practitioner for the type of work being planned and has a current certificate of domestic building insurance, and also check home and contents policy cover in case extra cover is needed. And finally, the ABC has also highlighted that the rate hike will bite particularly hard in Western Australia. This is because Western Australia has the highest inflation rate in the country at 7.6%. At the same time, we actually have the lowest wage growth of all the states at 2.2%. So we've got this pretty significant chasm going on for wages growth at such a low level and inflation rising at almost 3.5 times the rate of wages. And I would say that if you are financially struggling and need help, you can contact the National Debt Helpline for free on 1800 007 007. But the point I want to leave you with is that borrowing power has already been reduced and will be reduced further. And the other thing that we're noticing is that the valuation coming back on properties now for the purposes of mortgage lending are also dropping by around 10 or 15% on average. Combined movement of lower borrowing power and lower mortgage valuations will put significant downward pressure on mortgage lending ahead, and that in turn will translate to lower home prices because, as I keep on saying, there is a very strong relationship between what happens to the amount of lending in the system and home prices itself, which is why my scenario of falls at least 20% over the next year or two seems probably now a base case with more risk to the downside. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.